In this example, we will consider a problem of a company that is considering financial implications of a possible addition to a heavy equipment line. So there is a number of considerations here you can see in the text. Startup costs uh, are about 100,000 euro. The new product would be sold at a price of 25,000 euro per unit. Fixed costs are 15,000 per year, while variable costs should be 70% per year. Tax depreciation on the new equipment would be 10,000 euro over the expected 4-year product life of this G9 product. The salvage value of the equipment is conservatively assumed to be zero, and there is 10% cost on capital and 40% tax rate. And then the most uncertain element is the demand for this product G9, which is estimated to be around 10 units per year. So this is some kind of expensive equipment that we're producing and selling here. So a cash flow model has been created here, and we are now in the Excel file that has the cash flow model, right? And we want to appraise the risk of this project using Monte-Carlo simulation. In the simulation, we're supposed to assume that the demand each year follows a Poisson distribution with an average rate of lambda 10 units per year, right? So we have several questions here. Before we consider questions, look at the spreadsheets that we see here. We have the cash flow with some input data here that are listed, right? Startup cost, selling price, fixed cost, and depreciation, the variable cost as a percentage, the discount rate, tax rate, and estimated demand 10. And now here, the data is actually calculated year by year, revenue, fixed cost, and so on. There is a net cash flow calculated as the right after tax profit and based on after tax profit and depreciation and so on. And so you see there are calculations here. You can trace all of them. But the important thing is you have the final output is the net present value, which is the net result taking into account the initial startup cost $100,000 and the expected profits in every year $40,000. And of course, we can now calculate the NPV based on those values, assuming a discount rate of 10% for future payoffs. So this is a deterministic model that is actually prepared for us, right? You might have some models like this in your life for finance problems, for other decision problems, right? This is a deterministic model that just assumes 10 units of demand every year. And they are saying now here in this exercise, well, this is the most uncertain thing, the demand 10. We actually expect 10, but the number may vary. So what will happen if this number is different? We will try to answer through a simulation.